Good afternoon, everyone. It's Phil Grant with Baird and Warner in Crystal Lake, welcoming you to another edition of the Real Estate Minute. This is, of course, as you know by now, the place where we talk about all things real estate, be it buying, selling, leasing, be it commercial or residential, really in the hopes of helping you to make a better, more informed decision when real estate matters come up in your world. Now, we hope that this somewhat chilly March day finds you and your loved ones safe and healthy and well. We are getting closer to those warmer days, which I know everybody is looking forward to. Yesterday, I posted on social media an article about 1031 exchanges, and I thought we'd take a little deeper dive into that today. Before we do that, however, I would like to reference a webinar that I sat in on yesterday. And this webinar was basically talking about commercial real estate. There was a fellow on there from Morgan Stanley, there was a fellow on there from JP Morgan Chase, very educated men. And my key takeaway from that whole webinar was simply that the commercial sector of real estate is really better positioned to come out of this pandemic time that we've been going through than many people thought. Debt levels are certainly very good. A lot of the people that have owned especially large buildings and even smaller ones have worked with their tenants to work through this whole time frame, whether it be abating rent or whether it be restructuring the leases. So really, again, my key takeaway is that the commercial market is going to come out of this just fine. We certainly know the residential market has, but so that was very good news, I thought, on that front. Now, as to 1031 exchanges, where does the name come from? It very simply comes from the United States Internal Revenue Code. It's Section 1031. What does it allow sellers of commercial investment properties to do? It allows those sellers to defer the payment of the capital gains taxes. And the benefit to that, obviously, is that it frees up capital for their next purchase. And you could be moving for a number of different reasons. Maybe you started a company 10 years ago and things have gone very well. Maybe you need more space now, so you want to sell that first building and get into a bigger building. So that could be a reason. There are a number of different reasons why you might utilize this. So I thought we'd take a quick look today at just a few of the key components of the 1031 exchange. And as you can see behind me on the old whiteboard, it says like-kind property. What does that mean? It means that, for example, if you have an office building and you want to buy a bigger office building, can you do that? Absolutely. If you have a piece of vacant commercial ground and you want to sell that, can you buy an office building? Absolutely you can. What you cannot do, however, is let's say you have an office building and you want to sell that and you want to buy a way fancy piece of art. No, you're not going to be able to utilize the 1031 there. So again, like kind meaning investment commercial grade property for investment commercial grade property does not exactly have to be the same type of property, however. Depreciation comes into play, obviously. When you own a building, you are going to depreciate it over time. Wear and tear take their toll, and the tax code allows you to depreciate that. And when the building is sold, capital gains are figured on the net adjusted amount after the depreciation has taken its effect. So again, depreciation is going to come into play here. There's another term called recapture. We won't get into that right now. But that's very important to know how that building, how that piece of property has been depreciated over the years. Qualified intermediary, what is that? A qualified intermediary is a company or a person who is willing to take the proceeds from that initial sale and hold those proceeds until the seller of that property finds a new property to purchase, at which time that money gets transferred back to the seller so that the second transaction can happen. So if you are in a 1031 situation, obviously you will need a qualified intermediary to act on your behalf. Then finally, for our quick discussion today, we talk about timeline. You can see that down here at the bottom, where we have 45 and 180. What do those numbers represent? Once that owner of that commercial property sells that property, that money, as we said, gets transferred to the qualified intermediary, and then the seller then has 45 days to identify up to 3 properties. And then after that, the seller then has up to 180 days in order to complete the transaction on one of the properties. And then obviously the qualified intermediary then transfers that money back to the seller so that he or she can make the second purchase. So again, 45 days, 180 days, very, very important as far as the timeline goes here. And that is one of the keys of doing a 1031 exchange, is to make sure you're meeting those guidelines. Now, there are some other rules that we can talk about. We won't get into them today. If you or someone you know owns commercial real estate, thinking about selling it, number one, you ought to call me so that I can give you some professional help. But number two, let's make sure that we are sure about whether or not a 1031 exchange is good for you. So we'll leave the 1031 exchange talk there for the time being. Again, if you need more information on this, if you need help getting a commercial building sold or leased or even purchased, please reach out to the old problem solver at 815-788-2198, and we will do everything we can to help you. Again, 815-788-2198 if I can help. Thanks very much for watching. Take care of yourself, take care of your loved ones, and we'll talk to you soon. Thank you.